Hey everyone, if you've been keeping even half an eye on India's financial landscape lately, you've definitely noticed the buzz. We're seeing millions of new investors, surging SIPs, and asset management numbers that are just breaking records left and right. But today, we're going to peek behind the curtain. We are going to uncover the actual mechanics of this massive wealth boom. Think of it as the market's hidden engine.
Now, here's the thought for you to chew on. What if you didn't just invest in the market, but actually owned the market itself? It kind of flips the whole script, right? Instead of agonizing over trying to pick individual winning stocks, what if you focused on owning the very infrastructure that allows everyone else to make their trades? This really goes back to a classic, battle-tested concept known as pick and shovel investing. Think back to the great gold rushes. The surest, most consistent money wasn't necessarily made by the prospectors digging in the dirt hoping to strike it rich. No way. The real money was made by the clever merchants who sold those prospectors their picks and shovels. Well, in today's modern financial gold rush, those picks and shovels are the platforms, the brokers, and the exchanges that literally make the trades possible. All right, moving right along to Section 1, the scale of the boom. The sheer velocity of adoption we're seeing right now is just incredible. Demat accounts in India have absolutely exploded. We are talking a jump from just 5.5 crore back in the 2021 financial year to a projected 22 crore by 2026. That is millions upon millions of new investors who all need digital platforms to trade on. It's a massive shift. And it's not just the number of accounts going up, it's the sheer volume of capital flowing in. By March 2026, mutual fund assets under management in India are projected to hit a staggering 76.81 lakh crore rupees. To put that into perspective, that represents a 22% compound annual growth rate over a decade. The pool of managed wealth in this country is expanding at a breakneck pace. So, where on earth is all this money coming from? Well, look at everyday households. The flow of net household financial savings going straight into equities and mutual funds has basically tripled. It grew from just 5% in the 2020 financial year all the way to 17% in 2024. What we're witnessing here is a foundational behavioral shift across the entire country. People are moving away from just passively saving their money, and they're actively investing it in the markets. Okay, let's dive into Section 2, understanding the ecosystem. When we talk about the shovels in this specific ecosystem, we're really talking about the businesses that benefit directly every time capital market activity goes up. Think about it. When more people open demat accounts, stockbrokers and depositories win. When SIPs and folios multiply, asset management companies and financial product distributors see their revenues jump. And when overall trading volume and IPOs surge, exchanges and clearinghouses capture that transactional value. They are the absolute essential enablers of the entire market. Now, if we look at the Nifty Capital Markets Index, which tracks these exact types of companies, the breakdown of market cap is actually pretty revealing. Only 15.9% is large cap, a massive 54.3% is mid cap, and 29.8% is small cap. So what does that mean? It means this ecosystem is heavily driven by dynamic, fast-growing mid and small cap companies. It's not just dominated by the traditional slow-moving giants. Let's transition to Section 3, the penetration gap. Now, despite all those massive numbers we just covered, there is still an enormous amount of white space left for future growth. See, India's mutual fund AUM to GDP ratio has doubled over the last decade, hitting around 20%. But when you compare that to the global average of roughly 64%, well, India's penetration is still incredibly low. This highlights a really massive long-term structural opportunity as our domestic investor base continues to deepen. We're still early to the party. Which brings us to Section 4, inside the Axis Fund. So how do you actually capture this specific thematic growth? Well, one way is through the Axis Nifty Capital Markets Index Fund. It's an open-ended index fund managed by Rohit Gautam and Andik Malik. Its core objective is pretty straightforward. It aims to track the Nifty Capital Markets Total Return Index. This basically gives investors direct exposure to the performance of those exact ecosystem companies we've been chatting about. If you're looking for the specifics, the new fund offer, or NFO, runs from May 4th through May 15th, 2026. And hey, because it's an open-ended scheme, if you happen to be catching this explainer after the NFO period has closed, don't worry. Continuous ongoing investment will be available shortly after the allotment date. Honestly, what really stands out here is just how accessible this is. The minimum investment amount is just 100 rupees. Literally $100 for both SIPs and lump sum investments. It makes participating in the growth of India's financial infrastructure something virtually any investor can do.
All right, let's get into Section 5, Risks and Realities.
Now for some real talk. To give you the complete, impartial picture, we have to look at the realities of thematic investing. According to the scheme documents, both this fund and its benchmark fall squarely in the very high-risk category. It is absolutely crucial to understand that this is not a broad, conservative, play-it-safe savings vehicle.
And the reason the risk is so high boils down to one thing: sector concentration risk. Unlike highly diversified index funds that spread your money everywhere, this fund's hyper-focus means you are going to see higher volatility. If Indian markets take a sharp fall, trading volumes and overall investments will drop. And if that happens, these specific capital market companies, and by extension this fund, will be directly and heavily impacted. It's a double-edged sword. The Axis Beginner's Guide shares a really foundational investment philosophy that I love. It says, do not save what is left after spending, but spend what is left after saving. I think that completely hits the nail on the head. It perfectly captures that powerful behavioral shift we are seeing across India right now, the exact shift driving the growth of the whole ecosystem we've been exploring today.
So I'll leave you with this. Are you ready to plan your next financial milestone? The infrastructure of the market is evolving at lightning speed, driven by millions of new participants jumping in. The opportunity is definitely clear, the risks are totally defined, and the landscape is shifting right under our feet. So how will you choose to participate in India's financial future? Thanks so much for joining me on this explainer, and as always, keep learning.